Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by Takahiro Sekido, Chief Japan Strategist for MUFG. It's Monday, February 27th, 2023. Welcome back to the podcast, Sekido-san.
Good to be back.
Always good to have you on. So the nominees for Bank of Japan governor as well as the deputy governors have been undergoing screening before both houses of the Diet since this past Friday. If I'm not mistaken, the governor is done with both the lower and the upper house, and I think the deputy governors are supposed to testify on the 28th, which will be the same day as this podcast drops. But why don't we start the episode by discussing your impressions from the hearings, at least thus far?
BoJ Governor nominee Kazuo Ueda and Deputy Governor nominees Shinichi Uchida and Ryozo Himino have been extremely cautious, prudent in their responses to the questions. I think this is because of a combination of the LDP intra-party machinations following the delays in the nomination process and reshuffling of new nominees, as well as questions about continuation of Abenomics policies and recommitment to Prime Minister Yasuo Kishida's new style of capitalism. Separately, there is some speculation that ongoing Governor Haruhiko Kuroda will spring a surprise at his last monetary policy board meeting in March. For example, to eliminate the yield curve control range 50 basis point plus minus to normalize the monetary policy settings for the new governor. So we maintain our view of upward bias for yen rates and wide bias for yen basis. We expect the complex monetary policy operation settings put in place under Abenomics to be altered under the new BoJ leadership, which will likely shift toward a more moderate and simplified style of monetary policy management. Apart from internal LDP political factors and mixed market speculation, we think that, given the complexity of current monetary policy operation, the incoming leadership will tap his academic experience and look to economic theory to at least return to the monetary policy style of prior to 2016.
Okay, yeah, you've spoken previous episodes as well as in your written research about how complicated monetary policy has been, and so some sort of return to simplification would make certainly make a lot of sense to me. Really interesting though that you think there's a possibility that Kuroda surprises markets again and potentially removes the band around yield curve control before leaving office. I mean, to some sense that's unthinkable because he leaves his successor, with potentially a mess on their hands, but perhaps, he rips the Band-Aid off, which allows the successor some sort of, flexibility. So very interesting, very interesting to consider. I don't think that's something that most people would think is intuitive. So definitely a lot there. Let's see. So digging in a little bit more, you put out a piece on February 21st. It was one of your JPY cross-asset pieces ahead of the hearings. In the piece, you discussed both foreign direct as well as securities investment for Japanese investors and companies, as well as the incoming Bank of Japan administration's impact, how both those things, or all of those things rather, could impact JPY basis. Why don't you take our listeners through some of the key points of the piece?
We expect the yen basis to widen under the new BoJ leadership. After clarifying the present uncertainty of the BoJ's monetary policy direction, then the Japanese investors, Japanese companies, they can start to rebuild both their foreign bonds and also foreign direct investment assets with yen basis. In 2022, Japan's balance of payments data showed the current account balance of 11 trillion yen, primary income balance of 35 trillion yen, direct investing of 17 trillion yen, securities investing of 19 trillion yen negative. During Abenomics, Japan's overseas assets expanded to the 1,249 trillion yen at end 2021. We have been watching how much this corporate sector's out of FDI and earnings have grown amid the structural changes in external account balances during Abenomics. The income account stood at 35 trillion yen in 2022, but securities investing revenue were only 10 trillion yen. The corporate sector's overseas FDI balance grew from 30 trillion yen in 1996 to the 228 trillion yen in 2021, with out of the FDI revenue rising from the 1.4 trillion yen in 1996 to 23 trillion yen in 2022. However, direct investing by Japanese, primarily direct FDI by companies, rose by 17 trillion yen in 2022 despite the yen weakening. The securities investing account stood at minus 19 trillion yen, reflecting the selling of foreign bonds by Japanese investors and JGB arbitrage trading by foreigners, and the yen basis shrunk slightly. Japan's corporate sector expanded substantially overseas, not only the large enterprises, but also many small and medium-sized enterprises, stoking strong demand for overseas asset funding. Because of this, we think that yen basis could widen, depending on the changes in G10 yen arbitrage trading in global financial markets among both Japanese and foreign investors. Monitoring the yen basis market even more closely will be important from April onward when new fiscal year begins.
Okay, that's interesting. So it sounds like that you point out how Japanese investors have been, or Japanese companies rather, have been aggressively investing in FDI overseas, and then you expect that's to continue, as well as you expect all that huge net selling by Japanese investors of foreign bonds to sort of reverse and those investors to rebuild positions. Both of those things are obviously basis widening. That being said, widening really is not intuitive given that the Bank of Japan's policy is likely to be less easy, all of the things being equal. It kind of sounds like you're saying it's like a buy the rumor, sell the fact type situation. And also I guess I'd add that no matter how much normalization the BOJ does under Ueda-san, it's going to be de minimis versus what occurs by the Fed or even the ECB. So really good point there. So I guess, why don't you elaborate a little bit into other markets, specifically JGBs and JPY rate?
Okay. At end 2022, the balance of the outstanding Japanese government debt stood at 1,256 trillion yen, including 1,062 trillion yen of JGBs and 146 trillion yen of TDBs. During the Abenomics, the BoJ practiced massive monetary easing, resulting in the monetary base to grow to the 632 trillion yen from the 136 trillion yen in 2012, and BoJ's holding of JGBs to the 556 trillion yen from the 89 trillion yen, the TDBs to the 7 trillion yen from the 24 trillion yen. The BoJ's holdings grew to the 52% of outstanding JGBs, while its share of TDBs shrunk, so its weighting of longer-dated JGB holdings rose. Over the near term, yen rates could rise if the next BoJ governor makes changes to the BoJ's monetary easing and MOF fiscal spending goals, depending on how public debts are managed well.
Okay, so there's a number of reasons to be negative on JGBs or positive on JPY rate. Let's elaborate a little bit more on that, as well as your outlook across other markets. So in addition to JGB's yen rate, also spot dollar yen and yen basis.
Dollar yen is rising, but has not been able to breach the 136 level. Upcoming U.S. economic data ahead of the February job data will confirm the impact of rate hikes on the real economy. The BoJ Governor nominee Kazuo Ueda has indicated in remarks in the diet that he will take a cautious stance, prudent stance on monetary policy. Dong yen could turn volatile ahead of the March 9th to 10th BoJ board meeting because of mixed market speculation about an adjustment to the monetary easing policy before Kuroda's term expire. We maintain our view for Dong yen to trade in a 3 yen range of 134.50 to 137.50 with a bullish bias. The yen swap rate curve has declined and flattened. The limits of the BOJ's pooled cross-sell fund supply operations can be seen by the max tenor offered so far 5-year, 2-year on February 28th, and 10-year March 2nd JGB auctions are coming up. The BOJ will likely keep managing yen yields so as not to cause any waves even after the new leadership is confirmed. That said, the limits to the BOJ's fixed-rate JGB buying and pooled cross-sell fund supply operations in terms of ability to control yen rates have become apparent. So we now see the yen rates rising with a steepening bias. The yen basis curve has been flattened. Ministry of Finance weekly data shows that the Japanese investors net bought 2.4 trillion yen of overseas securities in the week of February 12th to 18th. This included a third straight week of net buying of medium to long-term overseas bonds by 2.6 trillion yen, the largest since March 2020. Separately, they sold foreign stocks and investment fund holdings by 202 billion yen for the fourth straight week. Over the same week, foreigners' inward investing came to 2.8 trillion yen, including net buying of short-term yen bonds by 2.4 trillion yen, medium to long-term yen bonds by 229 billion yen, and Japan stocks and investment fund holdings by 197 billion yen. As Japanese investors rebuilding of their medium to long-term bond holdings ballooned, foreigners actively arbitrage traded the short-term JGB TDBs and bought back medium to long-term yen bonds. The Tokyo market is closely interdependent on other markets around the world, and the Japanese investors rebuilding their foreign bond position supports yen bond trading amongst the foreign investors. For now, we expect the Japanese investors rebuilding their foreign bond holdings to dominate and see the yen basis maintain a widening bias.
Okay, so before I go over kind of summarize your outlook, I just do want to add additional emphasis to that. Excuse me, that large buying of medium to long-term overseas bonds. So Japanese investors, as you point out, bought the most since March 2020. Just looking at things here, I mean, the aside from that sort of unusual time when they were in the middle of the pandemic, would have been probably the most all time. So just a huge amount of buying, something like $20 billion there. Really notable. I would note that flows. We saw good buying, that week as well. Since then, as the global bond markets have continued to sell off, we have seen less buying. Perhaps Japanese investors are waiting for the piano to bounce before they pick it up, before they try and catch it, rather. So just kind of add that. But again, in FX, you are bullish on dollar yen with a 134.50 to 137.50 range. You have a steepening and a rising rate bias to JPY rates. You're negative on JGBs, and as discussed earlier in the podcast, you have a widening bias to basis, which is a little counterintuitive. So pretty interesting. Did I get that about right, Sekido-san?
Yes.
Okay, great. Excellent insight as always. Thanks for coming on the podcast.
Thanks for having me, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.